Just a couple things come to my mind. One, on the export side, it'd be good to compare the local currency numbers versus the U.S. dollar ones in case there's some currency effect, because there has been some movement in the currency. That's probably not a huge amount, but it's something to keep an eye on. Number two,
I can give you the local currency numbers if you want right now.
Fine.
So the May yuan-denominated imports grew 2.3% year on year, and the yuan-denominated exports grew minus 0.8% year on year. Could you put it together?
Okay, so I mean, I think...
And on the trade balance basis, it's 452 billion yuan.
Right, and the export number again, just the year on year?
The export number was a miness 1%.
Right, so less of a contraction than we saw in U.S. dollar terms, so there may be some sort of a currency effect there. Really, I think sort of to unpack this, I would say a couple of things. One, on the export side, as Sam mentioned, is this indicative of weaker kind of end global demand? We actually have a more constructive than consensus view, certainly on the U.S. Economy, and we've actually just slightly raised our numbers from 1.6 to 1.8% for full-year GDP growth. So there may be some give back, as I think Sam was mentioning, in terms of the maybe orders being fulfilled and sort of drawing down some inventories and so forth, which may be sort of clouding things. But overall, our sense on global demand is somewhat better, more robust than I think consensus. That'd be first point. Second is that there's some interesting data which has just recently come out showing that the mix of, from a U.S. import standpoint, the mix of China imports versus from other destinations, other supplying areas, has been coming down. So maybe a mix shift, which speaks to the whole longer-term theme of supply chain redeployment and so forth, which we need to see. We can't sort of draw too many inferences that from one data point, but that's a larger trend we should be aware of.
Do you think this is a structural issue that China is facing, or is this just normalization coming on the back of the pandemic? Because that's one of the views that John Lin from Alliance Bernstein, our earlier China guest, spoke about.
Cool. And Will's dying to ask questions.
No, I was going to say, to be fair, to the point that you're making, if we strip out some of the retailers, for example, inventories in the United States are huge. They're running well above the long-run averages, so that could also be playing into it, because they're not needing to play because they've got their own inventory issues of their own.
Correct. So I think there's a number of layers here before we sort of say, well, what are the underlying dynamics and what is the implication of this for the China economy? The other point I want to make on the import side, certainly compared to the surprisingly poor number of imports in April, and I was in the U.S. at that time speaking with investors right around the time all the data was coming out for April, and that was a big shock to the downside. It kind of what led to the sell down in the equity market, because that indicated that China's economic recovery was really sputtering. I think the May data would at least assuage some of those concerns, particularly where the local currency numbers which you mentioned, that might assuage some of the concerns and just suggest, not that things are super strong, but at least they're stabilizing and aren't regressing even further. So I think at the margin, my sort of super quick take on this would be not too bad overall. And I think that then sets us up to look at the other potential trigger points that the market's focusing on, which particularly would be whether there's some firmer policy support coming out. Now, our view on policy is not that this can be kind of a large-scale kind of shotgun approach a la 2009 to sort of 2011, when debt to GDP went from 150 to sort of 287%. It's not going to be that, but it could be more targeted and more focused, particularly with regard to the property market.